I'm just going to recap on what we covered yesterday, and you can ask me any questions that you have thought about overnight. Okay, we talked about why people don't have wills. Do you remember that? And there's such a high figure of people that don't have wills and the reasons why. And we came up with our own reasons why, didn't we? Why we don't have a will. At Thornton and Baines, you'd be fortunate in speaking to people who are older, and 100% of them probably need wills. So at your time in life, when you're young, of course, perhaps that's not so relevant, but the people that you'll be speaking to are going to be older and they're all going to need wills. And some of them will have wills, and you'll say to them the importance of regularly reviewing their will is crucial. Okay. And why is it crucial? Because they might have to change executors. They might need to add beneficiaries. It needs to be reviewed on a regular basis because life changes. So the government have a will for us anyway. What's it called? The government will. Anyone? Oh.
The laws of intestacy.
Yeah, that's right. That's right. Everyone knew that, didn't they? Yeah, everyone knew that. The laws of intestacy. Okay, and then we spoke about mental capacity. But we did say, and what a lot of hassle it causes if you die without having a will. All the hassle it causes people that have to finalise things on your behalf when you die. So much hassle without a will. Mental capacity, the 3 rules of mental capacity for a will. Do you remember those? I hope you do. And we went on to discuss what the format of the will. What information do I need to write a will? So that was right through the executors, beneficiaries, gifts. You remember all of that? And the registration of land, the land registry, are the people that hold all the information in regard to ownership of land in the United Kingdom and how it is owned. And we talk about joint tenancy and tenants in common. And sometimes the benefit of tenants in common to protect the property. Trusts, we spoke about those, and the things you don't have to include in a will, and that's joint property, isn't it? Because it's automatically inherited by the other person. And of course you wouldn't include a trust in a will, or a separate external trust, I mean, because then that has its own identity. You can put a trust in the will, yes you can, but a separate trust doesn't have to be mentioned in a will. And also things you don't own, of course. Some people, would you believe, have put things they don't own in a will. Yeah. The responsibilities of an executor. Wow, huge job. Lots of things to do. Lots and lots of things to do. So I hope you remember those. And the roles of trustees. So trustees are the decision makers of a trust. They decide how the trust is run and when to release the funds to the beneficiaries, the trustees. Guardianship. Yeah, so a will is the ideal document in which to explain who you would want to be the guardians of your children if you were to die. And we also spoke about parental responsibility. So we said that a woman, a mother, automatically has parental responsibility. A father, not in all cases, has to be married to the mother or on the birth certificate. Making gifts, spoke about legacies, charitable donations that people include in their wills, and gifts to people that are precious to them, perhaps grandchildren, and then the residual estate, so what is left over after making the gifts. Reserve beneficiaries, so the normal scenario is I leave everything to the children. And what about if the children aren't here when you die? So we have to state reserve beneficiaries. Okay. Foreign property, if you have a home in another country, you're very well advised to have a will in that country. And again, that would be money. If you had money in another country, say in the Black Forest, you've got some money in the bank account in the Black Forest, or in perhaps Manila or somewhere like that, or Australia. So yeah, you should have a will. If you have assets in a country, you should have a will in that country. All right, so what about gifts? The gifts that you're allowed to make that the HMRC don't want to know about. £3,000 every year we can gift. £250 to as many people as we want to, standing outside Gravesend train station there, Sam, with all your envelopes with £250 in each one. Okay, so yes, there are ways in which the taxman allows you to give away money, but it's very restricted how much they allow. And we know we can give our child 5,000, our grandchild 2,500, and anyone else 1,000 when they get married. Anything over and above that, you have to survive for 7 years after making that gift for it to be outside of your estate. All right, now, so the person setting up a trust is called a settler. The person setting up a will is called a testator. The person giving power of attorney is called a donor. Covered all those. Why would you put a trust in the will? If you have young children, you would put a trust in the will. So if you died, the money wouldn't be paid out to them. It would go into the trust, and the trust would be managed by the trustees until the children are old enough to receive the money. Or you might have a disabled child or relative. You could also set up a trust in a will for that purpose. Okay, so I think I've covered most things. Any questions now about anything we did yesterday?
By the way, on the exam, are we also going to cover lasting power of attorney?
Did we cover it, do you think?
For today's exam, are we going to cover that?
Yeah, it's in the exam. There are a few questions, because we went through the difference between a lasting power of attorney, do you remember, and an enduring power of attorney. You remember that, guys? That's important, because there's a difference. What's the difference between an enduring power of attorney, which is the old type, and lasting power of attorney, which is the new type? Do you know?
Enduring.
Enduring, you had no
Yeah.
authority on health and welfare. So.
Good. Good. Also, the other thing is that with an enduring power of attorney, if you elected more than one attorney, they would have to act together. With a lasting power of attorney, if you elect two attorneys, they can act either together or separately. More flexibility with a lasting power of attorney. Understand? So yes, enduring power of attorney, the old one, the old power of attorney, which was called enduring, was only for financial and property. The new one, lasting, you've got financial and property, but you can also have health and welfare. Very important. Okay. We spoke about what thing you do in life which voids an existing will. Okay. Who should you probably not have present when someone gives their instructions to you? Well, it's probably somebody that is going to benefit. You probably wouldn't want any beneficiaries present when someone gives instructions to a will, because they might be being coerced, you see. Okay, and if a couple come to you and they say, we want to give instructions to our will, you've got to be careful to check that they're happy to do so in front of each other. Give them an opportunity to do it separately, because they might actually want different things, and it might be a very touchy subject. All right, common law partner, the rules of intestacy. All right, deed of variation, letter of wishes. Yeah, okay with all that? going to go on to products. Has anyone read anything about products? I believe some information was sent through, but I'm not sure. We're going to go through quite a bit now. Anyone read anything about the products?
Are these the equity release and the other things?
That's right.
Yeah, a little bit.
Little bit, Oliver. Kimberly?
Yeah, just a little bit.
Little bit, Sam?
Yeah, I read a bit about it.
Okay, good stuff. Right, we're going to start with equity release. All right, so this is probably the biggest area of growth in financial services at the moment. And the reason for that is because house prices over the last 30 years and beyond have gone up pretty much year in, year out. There have been dips, of course, but what has happened in this country is that there's been a great desire for home ownership, politically driven back in the 80s. And I don't know if you remember, no, you won't remember, you're not old enough. But we used to have social housing, council accommodation. We haven't got much of that now because it was decided to sell it all off, give people the opportunity to buy it. Anyway, whatever you think of that, there's been a big drive to own your own home. And the UK being such a successful economy globally has also attracted a lot of foreign investment as well, which again has stimulated house prices over the years because it seemed to be a safe haven for people to invest their money. Okay. But the consequences are that there are a lot of people who are property rich but cash poor. Okay, so they're sitting on a property that's worth a lot of money, but some people have that, but very little money in the bank. So people have found that it is a sensible decision to try and release money from their homes while still living in that home. And that's what equity release is. There are two types of equity release scheme available now. One's called a lifetime mortgage, and the other is called a home reversion scheme. For what reasons do you think people release equity from their property? I'm listening.
To get some income.
To get income, to give themselves a more comfortable life. That's right. They may well be squimping and scraping to get by every month to pay the bills, but living in a big house or a valuable house. I mean, what's that all about? You know, so they've got options. They could sell the house and get a smaller house, or they could release equity. And when people get older, it's more difficult to move house. The reasons being for that is that they will have friends nearby. They may well be part of a community. They may be part of a church community or any other local community. They might have family nearby them. They might have all the facilities that they need around them, doctors, shops, transport. There might also be an emotional attachment to a home as well. Perhaps they've brought their family up there. Perhaps it means a lot to them to stay. Perhaps they want to hand down the property to their children. Okay. But one alternative to releasing equity is to sell your house and downsize. But some people choose not to do that. But Sam, yeah, that's a good point, to give yourself a more comfortable living. Okay, any other reasons people release equity?
To invest in other things.
Ooh. So Virgil, that's controversial. I can't hear you. Why do you turn it all on mute, guys? I can't hear you. Virgil, why is that controversial?
It's because you're gaining an advantage.
Right, okay.
I'm not very sure.
The concept, equity release is borrowing money. Okay, there's interest when you borrow money. Should you borrow money to invest money? Now that's a very risky business.
Yeah.
Because there is no guarantee whatsoever that any investment will grow more than the interest that you have to pay when you borrow. Understand that?
Yeah.
It's a big risk. So we never recommend at Thornton and Baines to borrow money to invest money. We believe it's too great a risk. So no, that's not a reason. Anyone else a reason why people would release equity?
To give money to other members of the family, perhaps.
Bang on, Oliver. Well done. That's really good answer. More and more popular because it's difficult to get on the housing ladder. Parents are helping their children to give them a deposit. One of the ways they can do that is to release equity. Great answer. Thank you. Any other reasons? No, okay. So people are in these properties that are worth a lot of money. They don't want to move. The trouble is they are finding it difficult to maintain that property well and make sure that it's comfortable for them. So I'm talking about the basic stuff like windows, roofs, making their home as comfortable as possible in their later life. Maybe I'm talking about building a facility for them to have the ability to wash and to go to the toilet on the ground floor of their home. So it's to give them the ability to live in a comfortable home for the rest of their lives. Now, the last thing that anyone wants to do in life, if one can possibly help it, is go into a care home. Nobody wants to do that. Would you agree? Yes, Andy, I would agree. So, in order to give yourself the best chance to stay living in your home, you have to adapt it sometimes so that you can live on one floor. so that you can be looked after in your home. So you've got the ability to wash and to go to the toilet and to sleep on the ground floor. Understand that, guys? That's another reason that people release equity. All right. There are also other reasons, and one of them is that in this country, before the crash of 2008, banks were giving away money without even checking the financial ability to pay back. Amazing the way money was given away without checking that people had the ability to pay it back. Of course, what happened in the end was that this debt went bad. Okay, so that was the result of that was a financial crash, which even saw banks go out of business. Who would have believed that? And banks being shored up, being supported by the government, by the taxpayer. You've all seen this, haven't you, over the years in the news? So now it's more difficult to borrow money. But if we go back in time, people borrowed money. Would you believe they could go into banks, certify that they earned a certain amount of money and no checks were made? Can you believe that? But it's what happened. Okay. And people on the basis of interest only. They only paid the interest. They didn't pay any capital off the loan. So there's thousands and thousands of mortgages which are running out there in this country that are going to run their period of time, and the capital is still going to be needed to be paid. People haven't got the money to do so. So equity release is the biggest growth area in financial services today. Okay. I'm going to talk, I can't stop coughing. I'm going to talk about the different types of equity release now with you. First of all, a lifetime mortgage. So lots of listening here to me. I'm going to talk, so be making notes. Make notes. So with a lifetime mortgage, you take out a loan that's secured on your home, which does not need to be repaid until you die or you go into long-term care. So it frees up some of the wealth that you've tied up in your home, and you can still continue to live in your home. So a lifetime mortgage is when you borrow money that's secured against your home, provided it's your main residence. You retain the ownership of the property. You may be able to get additional money, more money, if you're unwell. So the important thing to bear in mind is that if someone said, how much money can I borrow? Well, it depends on your age, the value of the property, and your health. Now, why it depends on your health is because if you're unwell, you're more likely to die. So it's a shorter term risk for the company that's lending you the money. So just to confirm, the home still belongs to you. and you're responsible for looking after it and maintaining it to a high standard. Interest is charged on what you're borrowed, and you have a choice. You can say, I want that interest added to the loan, or you can pay that interest. Okay, when you die or move into long-term care, the home has got to be sold. And the money from the sale is used to pay off the loan. Anything that's left over then goes to your beneficiaries. But if your family have enough other money to pay off the loan, when you die, they can do that and keep the house. That's possible. Lifetime mortgages have what they call a no negative equity guarantee. With this guarantee, what that means is that the lender promises you that you will never have to pay back more than the value of the home. So the loan cannot exceed the value of the home. So there's two ways that you can deal with the interest. You can say, please roll it up so you get a lump sum and the interest is rolled on top of the lump sum. So the lump sum gets bigger, the debt gets bigger. Or you can pay the interest every month. You can choose to borrow a lump sum. And if you were to apply to find out how much maximum that you could borrow on the home, you needn't have to take the maximum. You could take smaller amounts first and then top up as you go. Take more in perhaps in a couple of years and then another lump sum in a couple of years later. The advantage of that is that you're not paying interest on a huge amount straight away. So you're doing it bit by bit as and when you need the money. So whether a lifetime mortgage is right for you or not depends on your personal circumstances. It might affect what you leave to your beneficiaries as an inheritance, because the loan plus the interest being added on top, if you're not paying the interest, could eat into the value of the property. So the interest, when it rolls up, when it goes on top of the amount that you borrow, it will mean that you're paying interest on interest. You can get different types of interest rates with lifetime mortgages. You can get fixed rates of interest when you know that the interest that you agreed to will never go up. So the rate, the interest rate that you pay will always be the same. Or you can get variable interest when the interest, if interest rates go up, the loan interest rate will go up. Interest rate go down, the loan interest rate will go down. Now, we've never seen interest rates so low as they are now. Never. I think I did look this up. I think they might have been this low in the 1700s. So that really shows you. So that's really good thing for some people, because to borrow money has never been cheaper. It's really cheap to borrow.
Sorry, could you explain variable interest again?
Yes. So if I take out a lifetime mortgage, I have a chance to choose a fixed rate of interest where the interest that I pay will never change, or a variable rate of interest. So let's say today I borrowed at 2%. Next year, that interest rate could go up to 2.5%. The next year, go up to 3%. The year after, it could come back down to 2.5%. So I'm not fixed into a rate of interest. Do you get that, Sam?
Yes, thank you.
So a mortgage, a lifetime mortgage with a variable interest rate might not be suitable because the interest rate might rise significantly. I mean, for goodness sake, it can't go any lower. There's only one way interest rates are going to go in the long term, and that's up. So it could be sensible now if one was to borrow money. Kimberly, are you borrowing money to buy your place in Aberdare?
Sorry?
Are you borrowing money to buy your place in Aberdare?
We're gonna get it from a family member
Okay, that's handy.
as an investment.
That's handy, isn't it? Are they charging you interest?
No interest.
You're a very lucky girl.
Yeah, let's see how it goes.
Aren't you? That's nice, isn't it, everyone? Anyway, there we are. There we are. It's nice. Okay. One thing to bear in mind, if I release equity through a lifetime mortgage, I'm going to get a lump sum of money, and that's going to go into my bank account. We have to be careful because some people are on means tested benefits, like unemployment benefit or income support. So if you all of a sudden got a big lump sum of money in your bank account, you might not still get those benefits. It's an important factor to consider. Now, lenders will expect you to keep your home in good condition. By the way, guys, if you've got any questions, just butt in, won't you? So what does it cost? You'll have to keep paying the buildings insurance on the property, so you'd have to keep that in place. When you do any form of mortgage, there's going to be some legal fees and valuation fees, and there may be an arrangement fee to the advisor. Some other things to bear in mind would be, are you able to move? So let's say you took out a lifetime mortgage on one home. Would you then be allowed to transfer it if you wanted to move to a new property? Some schemes allow that, some schemes do not. It's important when you take out a lifetime mortgage to establish what would the situation be if I wanted to repay this amount of money earlier. So let's say I came into some money in a few years and I wanted to pay the loan off. normally there is a charge for you to pay back a lifetime mortgage early. All right, so that is a lifetime mortgage. So I mentioned there are two types, a lifetime one, which I've just explained. The other scheme that is available is a home reversion scheme. Now, I don't think many of these are done for people these days, although we must bear them in mind. But why they are not done as commonly as a lifetime mortgage is because it involves the sale of your property. So you sell your property, and let's say your property is worth 400,000. You arrange to sell it to a lender who gives you £200,000 for that, without any interest. But when you come to die or go into the care home, the lender owns the house. So that's why it's not common these days for people to lose ownership of their property when they want to release equity. I don't think it's as good a deal as a mortgage. But they're the two types.
Sorry,
Yeah.
for home reversion,
Yeah.
does it have to be your primary residence as well, or?
Yes.
All right, fair enough, thank you.
Okay. Any other questions? So the options you have with regards to the interest we covered, you can roll the interest up on the loan, or you can pay the interest. The minimum age which you can take a lifetime mortgage is 55. There's no upper limit. And the amount that you can release is down to your age, the value of the property, and your health. And lifetime mortgages must be repaid when you die, or when you are admitted to a care home. The no negative equity clause means that the value of the loan can never exceed the value of the property. You never have to pay back more than the value of the property. Of course, there are advantages and disadvantages of taking a fixed rate. I don't see a disadvantage at the moment with interest rates so low. But if you took a fixed rate of interest and then interest rates went down, you would be paying more interest. And the benefits you could lose when you take equity release are state benefits, means tested state benefits, because some of them don't pay out to you if you've got savings. Okay. Any questions regards equity release? What do you think of equity release? Let's go round. Oliver, what do you think of equity release?
I wouldn't touch it.
Okay, tell me why.
Would just rather sell, really. It just seems like it's like robbing Peter to pay Paul. I would just downsize and use the money for other stuff.
Okay. yes, I think it's probably the preferred choice to move, to downsize. I'd agree with you. Would you understand why some people don't want to do that?
Well, yeah, it's personal preference, isn't it? But me personally, I wouldn't do it. I would just sell it.
You understand why some people don't do that?
Yeah.
And some people don't want to do that. Because those are very important questions. Tell me why. Tell me why then.
I can't. Sorry, it's the feed is cracking. It's going all slow again.
Okay, tell me why somebody might not want to downsize.
Well, I guess if they've lived in that house all their life and stuff like that, there's a lot of emotional ties. Might mean like moving to trying to find like another property and stuff where they like in a certain area. Moving house is generally quite labour intensive, isn't it? So
Quite stressful.
yeah, those are sort of the main reasons. I understand why people don't want to move when they're old, but
Sam, what do you think about equity release? Lifetime mortgage.
Yeah, it's quite smart for maybe short term. But if you're living more than 15 years, I can't really see how you can stretch that money. So, and then you owe it back at the end when it's sold. The house is sold eventually. So, I think it's quite negative. There's a negative impact on sort of the people that inherit, take your inheritance
Yeah,
to
can
the
do.
children, so they obviously get less. So I've got kind of mixed
Mixed
opinions on
feelings.
it.
Yeah. Do you think old people then should struggle along trying to make ends meet because they want to leave money to their children?
Obviously, it's not the most important, but I've just thought from sort of perspective of maybe their children or people that inherit the house. Yeah.
So you think older people should struggle along so that they can give their children money?
Nothing. It would have been, like Oliver said, probably more wise to sort of move out into a smaller home if they want to.
Yeah, I agree. I agree with
If
that.
they're open to that.
I agree with that.
But obviously,
Okay. There's a lot of people that do not want to do that. For many reasons. It's not an accident that this is the main growth area in financial services. Why are you smiling, Oliver?
sorry,
Why are you smiling?
I'm grinding my teeth.
Are you? Why?
I got one that's it's a bit sore.
Okay. Kimberly, what do you think of lifetime mortgages?
Yeah, must agree. Bit mixed feelings about it. I think it's if a parent if parents don't have the money to give their children a deposit on a house, it is a good way to give them like 20% of a deposit to actually afford to get on a property ladder, because I think a mortgage would be in the long term better than rental, because rent in London, for example, is like 800 for a room. So if you put that 800 in a mortgage payment, your child will be better off, definitely. But on the other hand, I agree, like it is a big risk with like interest and added on top of that, and then having that responsibility after your parents die to pay off the loan. There is a responsibility. Do you have the money to pay off the loan? It really depends.
Would you say that it is particularly attractive for single people?
What do you mean? If you have a house and you're single?
You haven't got any children to leave your money to?
Well, if you don't have cash, you just sell it, but it wouldn't be really attractive to single people, I think.
Why?
I would just sell it. Just sell the house, get downsize, get your cash, have no risk. Yeah. I think, yeah. But if you want to keep your house and you're single and you get a loan, then you have to make sure you have that money to, like, well.
Okay.
Pay off,
Okay. Yeah. Okay. What do you think, Virgil?
I think it depends on their situation. Like, for example, if, for example, your children do not have any interest in your home, and you need the money, and but the place is important to you. For example, you have a garden that's very important to you. Then yeah, this is a good option because you don't have to leave your home, and if the children don't really mind not getting the home eventually, let's say for example they're well off by themselves anyway, then yeah, this is a good option. But if, for example, the children, but for example, also the children are well off and are able to pay off the loan that you took, and they still want to keep the house, then they could just pay it off themselves.
Yeah.
So yeah, I think it would depend on someone's situation.
Very much so. Very, very much so. It's got to be the right thing for them to do. And there's a lot of factors involved in that.
Yeah.
Yeah. Yeah. Okay. Good. So that's equity release. Any questions about equity release? Lifetime mortgages? No, you got all that. Okay. Good. Good. Okay. We're going to go on. What should we go on to now? We're going to go on to inheritance tax. Okay. So if you've got any questions, interrupt me. I don't mind being interrupted. I'm just going to talk to you now for a while. Okay, so inheritance tax is a tax on the estate. So that means the property, the money and the possessions of someone who's died. Now, there's no inheritance tax to pay if the value of your estate is under £325,000. No tax to pay. There's also no inheritance tax if you leave your money to your spouse, to your civil partner, or to a charity. Okay, you always have to report your estate value. So we're thinking here the executor has to report the estate value to the HMRC, even if it's less than 325,000. Okay. If you give away your home to your children, which includes adopted children, foster children, stepchildren, or your grandchildren, your threshold increases to £500,000. So that's the nil rate band, 325,000, with the additional residential nil rate band, which is 175,000. Okay. So if you're married and you're in a civil partnership, so one of those, and your estate is, sorry, let me start again. If you're married and or in a civil partnership and you leave everything to that person, your spouse, then when that spouse passes away, he or she can use your nil rate band and residential nil rate band, which means, in effect, let's take a couple. When the final one of them die, there is £1 million in nil rate bands to use. Okay? Interrupt me anytime if you don't understand anything. I don't mind being interrupted. The rate of inheritance tax. So the standard inheritance tax rate is 40%. And it's charged on the part of your estate that's above the threshold, dependent upon your circumstances. Introduced not long ago was the ability to leave 10% of your estate to charity. If you did that, then you'd only pay 36% inheritance tax. So it would go down from 40 to 36%, the tax rate, if you leave 10% to charity, 10% of your whole estate to charity. Okay. Making a gift. Now, there are a number of exemptions that HMRC don't want to know about during your lifetime, and that's the annual gift allowance of £3,000. We can all give away £3,000 every year. HMRC don't want to know about that. We can give away £250 to as many people as we like. It's got to be a different person every time. They don't want to know about that. That is to enable us to give presents, essentially. That's why it was established, so we don't have to make note every time we give someone a gift when it's birthday or Christmases. And we know that we can give our children £5,000 when they marry, when they get married. We can give our grandchildren £2,500 when they marry. And we can give anyone else £1,000 when they marry. And HMRC do not want to know about that. Okay, so when someone dies, as we've said, a return has got to be made to the HMRC by the executor of the estate, the person dealing with the deceased estate. Okay, so he or she is responsible for paying the tax bill. Once it's been assessed, there is 6 months to pay that tax. If it's not paid within 6 months, then interest is added. Going back to gifts for a minute, I can give anybody anything I like. We all can, can't we? But if the gift is above £3,000, then the amount of money that you give away will be returned to your estate if you die within 7 years. Do you understand that?
Mm-hmm.
All got that? Okay. If I give away a sum of over £325,000, then taper relief is applied, but the gift must be above 325,000 for taper relief to apply. Taper relief comes in the 4th year after giving the gift, and that means that a sliding scale of inheritance tax is paid. Okay. So, you know, you can give away to your husband, your wife, your civil partner, as much as you like. There's no tax. Okay.
Mm-hmm.
Won't be a second now. Giving away a home before you die. Okay, so people often will speak to you about this. You can give away your property if you like, and if you move out of that property, that's fine, no problem at all. The 7-year clock starts ticking. But if you want to continue to live in your property after giving it away, you'll need to pay rent to the new owner at a market rent. You'll have to also pay a share of the bills. It's very dangerous giving away your property and keeping living in it, because of formally you've changed the ownership, and if you give your property to your children and your children are, let's say, in a relationship or a marriage that breaks down, their partner essentially has claim to what they own, and they will own some of your property. So that's a dangerous game. You do not have to pay rent to new owners of a property if you only give away part of your property. So people sometimes have a house which they split into flats, maybe top floor, bottom floor. So if you were to give away the top floor and you didn't use that top floor at all as living accommodation, that may be acceptable. You can't continue you can't give something away and continue to benefit, to continue to use it, you see. That's the key. Also, if your family, if the new owners live with you, so if you give away your home to your child and they live in the house, that's okay. That's acceptable. Okay.
Sorry, I didn't catch that. You said if you give away the property, then the child has the right to live in the house.
No, if you give away the property and the child lives in the house. So
Which you gave to them.
Yeah, you live, there's you and your wife, and you live in a house, and your son lives with you. He lives in the house.
if he
Harry.
gets part of it.
Yeah, that's okay as long as he lives in the house with you.
Ah, okay. So he can you can give him the whole thing,
Yeah,
and as long as as you live together in the same house,
yeah,
it's still considered a gift.
yeah, that's right. It's a gift to him, but you wouldn't have to pay the rent.
Okay, excellent.
Okay?
Mm-hmm.
Okay. Domicile. What does that mean? Deemed domicile. Anyone know what that means?
It's where you live most of the time in a certain place.
Yeah. Okay. Yeah. Yeah. What you considered home. Where you're sort of resident for tax purposes. And a measure of being how you're deemed to be domiciled in the UK. You're deemed to be domiciled in the UK if you've lived in the UK for the 15 of the last 20 years. So HMRC treats you as being domiciled in the UK if you've lived in the UK for 15 of the last 20 years, or also had your permanent home in the UK at any time in the last 3 years of your life. So deemed domicile is all about where HMRC deem you to live and pay inheritance tax. Okay. Now, someone who's deemed domicile, if they die, then their worldwide assets would be taxed. If they're deemed domicile in the UK, their worldwide assets would be taxed on death. Okay. Did you understand taper relief?
Mm-hmm.
So taper relief only comes into being if I gift over a sum of £325,000. If I survive for over 3 years after giving away a sum of money over 325,000, but then I die in the 3rd year, that money comes back into my estate and becomes taxable, but not at 40%, at 32%. So there's a sliding scale dependent upon how I live, how long I live. If I live over 7 years, there's not a problem. But if I live less than 7 years, the money comes back into my estate. Okay. Okay. So that is a little bit about inheritance tax. Do you have any questions? No, no questions. Okay. Good. So, Did any of you read a guide called An Introduction to Wealth Management?
Yeah.
Yeah, did you read that, guys?
No.
Was it one of our PDFs from
Yeah.
like the products? I
Yeah.
think we've read it in the past. Yeah.
Good. In there it said, it told you about how many years of expertise do Thornton and Baines have at their disposal. They were talking about the personnel, really. Do you remember the figure?
Yeah. 16.
Okay, so the company's been going for 16. Okay, that's right.
Mhm.
However, we have some quite old people at Thornton and Baines, don't we? Like me. Yeah,
Mhm.
yeah. So, Des, anyone seen Des? He's quite old as well, isn't he?
Mhm.
And then Terry. Well, Terry's not that old, but you know, he's getting on a bit. So we have over 100 years of experience. That's quite a long time. And we have access to the whole of the market. The beauty of being an independent financial advisor is that you can pretty much do anything that anybody wants that's available via the global markets. So we have access to well in excess of 4,000 funds that we can pick and choose from in order to formulate our portfolios for people. And people can ask us to be bespoke as well. They can choose, they can instruct us, and it's very rare, but to buy a certain fund for them. But that's really rare. We are fund pickers, so we choose funds that are available via the whole of the market. So the portfolios that we put together are all about diversifying across the asset classes. There are 4 asset classes, 4 main asset classes, and those are cash, bonds, equities, also called shares, and property. They're the 4 asset classes. Cash, I tell you what, if your money's in cash, it's not going to grow, is it? We all understand that. I don't know what interest rate you could get on cash. Very little. Even if you have accounts where you have to commit to investing for or leaving your money there for a couple of years, you might get 1%. Now, what's the rate of inflation?
2%.
Yeah.
Mhm.
So if you put your money in cash, there is a real likelihood that over time that will lose its value. So if I look up, because everyone wants to go, well, do people want to go on holiday? And you look on your phone for a holiday and you see it costs £1,200 for this year. The chances are next year it will be £1,300. So that's the effect of inflation. If you leave your money in the bank, that money will not grow in the same way. Do you understand that? Good. Bonds. There are 2 types of bonds. It's a widely used term. But bonds in portfolios are made up of something called gilts, G-I-L-T-S, and corporate bonds. What is a gilt? Anyone know?
The
It's a
government bond.
government bond.
Sorry, Harry?
No, he knows it as well.
It's a government bond.
Good. Okay. And what's a government bond?
So
Can I-
basically, you lend them money, and they pay a rubbish rate of interest, and then
Okay.
give you the money back at the maturity of the bond.
Good. Good. So,
Fixed rate.
I tell you what. How much has the government borrowed recently? Must be huge amounts. Huge.
Yep. Hmm. Oh, so bonds are going to go up maybe because they need money. The yield will probably go up.
Yeah.
Okay.
So, you know, the government, they tax us. They do that for a reason, to pay for the health service, to provide all sorts of services to us, to turn the lights on, to keep the country and its infrastructure strong. Tax. However, the tax that they receive from income tax, inheritance tax, capital gains tax, all these taxes, corporation tax, it's not enough. It's not enough to run the country. So in order to raise additional funds, they need to borrow money. And the government go to the market and say, we need to borrow money. And the market providers, I don't know, banks, insurance companies, large institutions say, okay, we'll lend you some money. How much are you going to give us back? What interest rate are you going to pay us? Now, people are actually quite keen to lend to the United Kingdom government at the moment because it's a safe bet. So history shows us, because the UK government have always paid the money back so far. So let's say a big financial institution say, yes, I'll give you £1 billion. We'll give you £1 billion. What are you going to give us? Well, they say, we're going to give you 1% interest on that money. Okay, fine. It's not bad these days. Yes, we'll give you that, and we'll give you that 1% per annum. Good. And at the end of a term of years, so that's important, how long is it before we'll get our lump sum back? So that's what a gilt is. And people are positive about lending to the UK government at the moment. So it's quite easy for them to raise funds at the moment because they're likely to pay the capital back at the end. Okay with that? That's a gilt. It's the way, and all countries borrow money. The country survives on borrowing money. And do you know, if you looked at how much we borrow, you'd probably have a heart attack. Because it's hundreds and hundreds and hundreds and thousands of billions of pounds. As long as you can pay the interest back on your lending, you're okay. So why are you worried about your little credit card bill? Look what the government owns. No, but seriously. So that's one type of bond. The other type of bond that appear in portfolios are called corporate bonds. Corporate bonds. What's a corporate bond?
It's money that you lend to a corporation.
Good. Have you had something to do with these, Oliver?
Yeah, yeah, I've worked in this before, so yeah.
Okay, what have you done with bonds? Traded bonds?
Yeah, not me personally, but for the clients and stuff. Yeah.
All right. Okay, because that's right. So these bonds of all different types are bought and sold. Oh, blimey. Hold on a minute. Has everyone got their hub staff going?
Yeah.
You all use that?
Yeah.
Good, 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 good. Make sure you do. Otherwise you'll be in trouble. Okay, corporate bonds. That's right, Oliver. Corporate bonds are loans to companies. Simple as that. And let's say Mr. Sainsbury wants to build a new store. Now, Mr. Sainsbury has responsibilities to shareholders to give good dividends to them, to make the share price grow. So that's his main responsibility. But he wants to expand this company, get bigger. And you'll find companies, rather than use their money, their cash, they borrow.
Mhm.
They go to the market and borrow. So Mr. Sainsbury says, who'll lend me this money? I need £1 million to build a new store on the roundabout. And Mr. JP Morgan says, yeah, we'll lend you it. Right, but Mr. JP Morgan says, how much are you going to give me? So Mr. Sainsbury says, because he's got to give you more than the government to make it attractive to JP Morgan. So Mr. Sainsbury says, I'm going to give you 3%. You're going to give me 3%? I am. Okay, I'll have it. So 3% then, Mr. JP Morgan gives the money, owns the bond, and he's thinking this is fairly safe bond, this, because surely Sainsbury's can't go out of business. Surely. So I should get my money back at the end. So the million that I've given Mr. Sainsbury's, I should get it back. And he said that he'll give me it back in 10 years' time. Okay. And in between that period of time, he's going to give me 3% per year. Now, you get different classes of bonds, don't you, Oliver? So Mr. Sainsbury's is a fairly good banker. So they rate bonds, so they would call Mr. Sainsbury's probably a AA or something like that. But small companies borrow as well, less known companies. Who can think of a high street company that's gone out of business? Give me a name. Woolworths. What about Thomas Cook? Toys R Us. Mothercare.
Blockbuster Video.
Blockbuster Video. Yeah. So companies do go out of business. That's bad news for people that have lent the money, isn't it? They're not going to get it back, or they might not get it back. Okay. Corporate bonds, loans to companies. So in this scenario, Mr. JP Morgan has bought that, hasn't he? He's bought that. Mr. JP Morgan might sell it on. So bonds are traded. Bonds are bought and sold. So that's an important part of a portfolio. So we've got our cash, our bonds. So cash gives security, stability to a portfolio. It will not go down in value, but it will in real terms because of inflation. Bonds can give us returns over and above cash. So they're the next step up, if you like, from cash. Then you have equities. No, actually, then you have property, I would say, in regard to risk. But there's an additional risk with property. And that's liquidity. So when we're investing in property funds, we're not talking about the houses in the street, the places you're sitting today. We're not talking about that. We're talking about commercial property, shopping centres, office blocks. So funds, property funds, invest in that type of real estate. They don't buy a house. Okay, so we would see big shopping centres out of town. It's become more of the way now that we go shopping. The high street, not so much now. Big change over a period of time. What do we do in the high street? We go out to eat in the high street. We go out to drink a coffee in the high street. We don't do so much shopping in the high street. Okay, so property funds do have a good potential to provide good growth, good income, rents, growth, property prices go up, hopefully, income through rent. Okay, problems. I think a few property funds might be a bit worried at the moment. Do you?
Yes.
Yeah, big time. Will people go back to work in offices? Yes, but
Yes, but when?
But when? And also, will there be as many people working in offices in the future? When we've all found out that you can do a lot sitting at home, can't you? So things might change there a bit. Another risk with property is, look, I can't sell a bit of it. So if I've got this office block, I'm not going to be able to sell one floor. I can't. I've got to sell the whole lot. So it's got inflexibility, but it does have good potential for growth and income. Property funds. And the other remaining asset class, which are included in portfolios, probably to the highest degree, are equities, also known as shares. There are so many different types of equity funds, so many. Think of one: UK growth, UK income, European growth, European income, United States. Different countries have different funds. India, subcontinent. Oh, limitless, so many. When we put our money overseas, we've got to be careful because we have the added risk of currency exchange rates change. So that increases risk. But for goodness sake, of course you'd want some European funds. There's some fantastic, successful companies in Europe. Look at German car companies for a good example. Of course you'd like that in your portfolio.
Can I ask something real quick on that? I read recently that Chinese companies to invest in have a higher risk because they don't have as much regulation as an American company would or as a UK company.
That's a really good point. Let's face it, we do not know what comes out of China, whether it's the truth or not.
Mm-hmm.
We don't know, do we? They might have been telling us a few untruths about this virus, maybe. So I don't know, but you're absolutely right, Harry. Absolutely right. But there's some tremendously successful companies in China. My goodness.
Yeah, but then what about, I don't know if you looked into Luckin Coffee, where, they appeared on the books to be tremendously successful, but it's turning out to look like they cooked their books. So they showed profits and success that aren't there, and now the exchanges froze them. So now they can't trade until the investigation is over. Because you could say anything in the book, but how do we know if it's true at the end of the day?
All right. Okay. Excellent point. So let's make out for a moment. Let's dream for a minute that I'm a fund manager.
Okay.
And I'm running the Chinese fund for JP Morgan. Usually, in a fund manager, we'll have about probably exposure to 40 companies within his fund. I'm now idle. I keep being idle. Right.
So we hear you.
Okay. So if I'm a fund manager, I want my fund to deliver good growth or good income for people that invest in it. I'm going to be very careful regarding the companies that I invest in. And I might be looking after millions of pounds on behalf of people. I'm going to be very careful where I put that, what companies I invest into. So if I'm a fund manager, I think most of the time what I'm going to be doing is visiting companies to talk to their boards, to get an understanding of their account sheet and their plans for the future for growth. So I'm not going to pick any fund willy-nilly without a lot of research.
Right,
Okay.
right.
Okay.
And you have that power to actually, because you're managing so much money, you have the ability to find out the freshest information.
Yeah. Yeah. Okay. So lots of share-based funds. Shares are great. Shares are very like property. They can go up in value. They can go down in value. And shares provide dividends. Dividends. Income. They can provide income. Sometimes they don't. It depends upon the profit. But just like houses, commercial property, they can be empty. Oh, no income. Danger, danger. Okay, so they're the four asset classes. And dependent upon the level of risk that someone wants to take when you speak to them, you mix those asset classes. So if someone is more adventurous, you expose them more to shares. If someone is more cautious, you expose them more to bonds, maybe some cash. Okay. Risk. Right, we're all different. One of the most important things we do is conduct a risk profile with clients. Now, there's two aspects to risk. It can be a very emotive thing. Losing money, who likes it? Nobody. So you've got to try and get an understanding of the psychological feeling of someone in regard to risk. How would they feel if they invested some money and they got a statement 6 months later and it had gone down? Could they manage that in their minds? Would they lose sleep? Or do they understand that this happens? Always has. And that money has a very good chance of recovery. But it's over the longer term. You only invest for the longer term. The psychological ability to accept risk. Secondly, the financial ability to take risk. Would you invest everything you had into a risk-based asset? Probably not. So you would be looking to diversify people's savings and investments, not only within a portfolio, but yes, it's very important to have some cash. We need cash to be able to fall back on. We can't afford to put everything we have at risk. The best friend of anyone who wants to invest, time. Time. Have I got time? Of course, you'd be talking to someone who's 30 about investing and risking money. Of course, you'd be talking about someone 50. Yeah, I'm in my 50s. Would I invest? Yeah, I've got time. Would I talk to somebody who's 90 and invest? Tell him, put your money in Chinese equities. Probably not. We haven't got the time. Okay, so there we are. It depends on individual circumstances. That's why we're in the business of getting to know people. Getting to know people. We're really interested in people. Getting to know them. All right. To talk about trusts. All right, they're fantastic things, trusts. So inheritance tax we were speaking about. Okay, now let me put in simple terms for you what you can do if you have an inheritance tax liability in layman's terms, easily understood. Someone's got an inheritance tax liability. Number one, they have a choice to do nothing. It's a choice to do nothing and pay the tax. Who cares? Tax is a good thing. It keeps the country running well. Some people think that, few and far between, but some people do. Also, you'll find that some people don't do anything about inheritance tax if they don't have children. It doesn't mean so much to them. First option, do nothing. Second option, spend it. Spend it. Go out and spend it. What can you spend it on? See, a lot of things that you can spend it on have value. So that's no good. You can't go and buy a Ferrari because that's sitting outside. It might even go up in value. So you've got to go and waste it somewhere. You've got to go and gamble it. Got to go on lovely holidays.
You can buy a BMW, that's going to go down in value.
Oh, okay, good one. Spend it is an option. Spend it. You know, when you talk to a 70-year-old person, you tell them to go and spend it. He said, what do I spend it on? They don't know what to do with it. And you say, why did you save it all up? Oh, because it felt good to have behind me. It feels good. Just in case, just in case. All right, spend it. That's an option because spending it will decrease the value of your estate, won't it? Okay. Third, and that's what inheritance tax is about. It's about getting the estate down below the nil rate band so there's no tax to pay. Do nothing, spend it. Thirdly, give it away. Give it away. Yeah, give it away to the kids. Give it away to anybody you want to. It's your decision. You can do that. It's nice to help people. It's nice to help people in life. It makes you feel good. It's nice to give to your children with a warm hand, rather than a cold hand. Hold on though. Give it to the kids. Oh dear, that. Oh, who's Andrew's coming in? Andrew. Oh, I forgot Andrew. Hello, Andrew. We've only just started. It's okay.
Okay.
We were talking about what you can do about inheritance tax, and the first one is you can do nothing. It is a decision to do nothing, and some people take that decision. Secondly, you can go and spend it. That's difficult, but you can go and spend it on holidays, eating in the best restaurants every night, etc., etc. Spend your money. Thirdly, give it away. So that's where we were. Give it away. So give it to my children. Now, some people do that. A lot of people do that. And of course, we know that if you gift over and above a sum of £3,000, You have to survive for 7 years for that money to be outside of your estate. Okay. Otherwise, if you die, it comes back in. Some people are not comfortable in giving it directly to their children or other people. However, they still want to do something about it because they've accumulated more money than they need. So that's important. More money than they need. Do you think you'll use this money? I don't think so. I've got enough to fall back on. Okay, well, you can afford to give it away. I don't want to give it away. Okay, good. What can you do? You can put it in a trust, which is like giving it away, but you've gifted it to the trust and you stay in control of the money. It's like putting it in a safe and you've got the key. And when you put the money in the trust, the gift to the trust, a trust has a legal life. It's a legal entity in its own right. You give the money to the trust, but you stay in control of the money. Control of what? Control of who benefits. Okay. 7-year clock starts ticking when you put it into a trust. The trust can live long past you. A trust has the ability to last for 125 years, which is a fantastic thing, which is a fantastic way of helping not only your children perhaps, but their children and their children's children. And it makes you good when you set up a family trust, because you think, hold on a minute, that trust is still going to be alive when I'm dead. I'm going to be remembered. We all like being remembered. Okay. Trusts are wonderful things. They are confidential. A will is not confidential. When I die, one day, I've made a will, that will be published on the internet. Everyone will be able to see who I left my money to. Trust? No. Confidential, not published. It's only between. When I set up, I'm called the settler. Someone who sets up a trust is called a settler. Then we have trustees. Trustees look after the money. Look after the money and decide who benefits. Benefits. Settler, trustees, beneficiaries. One-way street. Settler, trustees, beneficiaries. Okay. Want to touch on the different types of trusts? I think I've covered this a bit with you, have I, guys?
Yes.
Okay.
You're talking about us.
Yeah.
Yeah.
Yeah. But you're getting it again, and it's good to get it again because I'm going to link it to a product now in a minute. Okay. So this one-way street, settler, trustees, beneficiaries. Two different types of trust in regard to beneficiaries. We have a discretionary trust, also called a flexible trust, where the beneficiaries are a class of beneficiary. My children, my grandchildren, my nieces, my nephews, a class of beneficiary. Whereas you have another type of trust which is called a fixed trust. Also a bare trust. Same, two words, same thing. A bare trust, fixed trust, where I name a beneficiary. Andy Oliver. This is who the trust is for. Fixed. With a bare trust, the beneficiary becomes entitled to the assets of the trust at a certain age, normally 18, or it can be later than that if specified. I'm going to be talking about a discretionary trust, a flexible trust, because they're the first thing normally to be recommended to people because they have flexibility. So, settlor, trustees, beneficiaries, class of beneficiaries. Okay. So, a trust is confidential. I can put my money into that for the benefit of whoever I like. No one knows about it, apart from me, the settlor, and my trustee, somebody I trust. I need to elect another trustee. I'll be a trustee until I die, but I need to have somebody else to be there when I go. So when we set up a trust, 2 trustees. The settlor will be a trustee and someone else. Harry,
Yes.
did you want to say something?
No.
No, okay.
Do the beneficiaries have to know about the trust or not?
No,
Okay.
no, they won't know. Not necessarily.
All right.
So, Andy, instead of having a will, can you just have a trust in place?
Well, chances are that you've probably got different types of assets in your estate. So you might have property, you might have possessions, and you might, no, you need the both. You can have a trust in a will, but that's to normally protect money for the benefit of children who are underage. So you're making a trust in this case to try and save inheritance tax. You don't want to give the money directly. You want to stay in control of it.
No, I understand all that. I'm just thinking of getting away from the will being published to the public. That's why I was asking that question.
Yeah, you wouldn't put everything you've got in a trust because you wouldn't want to lose access in your lifetime to everything, would you?
Mm-mm.
When you put something in a trust, you lose access to it most of the time. There are 2 types of trusts. I'll go through this with you. But a gift to a trust, you can't get the money back.
Mm-hmm.
So you need to keep some money behind you, don't you, until your dying day.
Mm-hmm.
You need somewhere to live till your dying day.
Yeah.
Yes, Christy?
Mm-hmm.
All right, so no, you need a will. And a trust is very helpful in protecting money and planning for inheritance tax, but maintaining control. All right, so discretionary trust. So we know it's confidential. Now, okay, fantastic. I put everything in a will. When I die, I've got to go to this probate. Probate. Remember that? Probate. I've got to have an interview with a probate officer to confirm that I am entitled to distribute the assets and to deal with the estate, pay the tax, etc. With a trust, there's no probate. Probate is a delay. It creates delay because it's a load of administration with a government body which traditionally takes forever anyway. So probate is a delay. When you have a trust, there's no probate. So if I set up a trust and then I die, my trustee, he can pay out the beneficiaries straight away if he wants to, following day. Because I've already said who I want that money to go to. Okay, no delay, no probate. But we've talked about the fact that the trust can last for 125 years. So he might not pay everything out of the trust, or he might. The choice is his. And he would have understood what I wanted to happen to that money.
So
Okay.
sorry to interrupt. What if you give instruction in the beginning? You're like, I want this money to go out in 10 years, to be paid out in 10 years. Then the trustee can still override that. He can pay it out in 3 years.
Yeah, you can. Yeah, you can. Yeah, he's in charge. I can specify on the trust document though, Harry, if I want any specific, if I've got specific direction, I can state it on the trust document.
But does that mean he has to follow? No, he can override it, even if you, right?
Well, if I've specified something, he should follow that. If I haven't specified anything, he can do anything he likes.
Okay, understood.
Yeah, so I can specify on a trust document. I could say, pay the beneficiaries on an annual basis until the trust has no money left. I can make instructions like that. Trusts are used, just reminds me, are used a lot for school fees, university fees. You can imagine, can't you? It's a lovely thing for, let's say, a granddad or a grandmother to set up a trust for her grandchildren that will pay the university fees. Lovely thing, isn't it, to do?
Mm-hmm.
A trust is a wonderful thing. Say that to clients when you speak to them on the telephone. Trust is a wonderful thing because it protects the money inside it from any third party. So if I name my children, my discretionary trust, my children, and then my children suffer a breakup in their relationship. Happens a lot, doesn't it? Their partner can't get that money. If I give them a gift of money that they put in their bank account or they buy a house with or something like that, there's the potential for that, for half of that to go away from the family. So a trust protects the money in it from third parties. And also a big third party these days is because everyone is living so much longer and care is becoming such a big issue for a lot of families. The money inside a trust is not financially assessed by the local authority to see if you need to pay care costs. Wonderful. From the trust that I'm going to talk to you about, you can draw income. You can have regular income coming out of it. Wonderful thing for a lot of older people is more income. So they've got a sum of money that they don't think they'll spend. But I wouldn't mind a bit more income coming in. That would be handy. That can be provided. Flexible, discretionary. What's flexible? When I set up the trust, I elect a trustee. I'm called the settler, but I can add trustees. I can take away the trustee. So say I elect my mate as a trustee and then I fall out with him, I can take him off and I can put someone else on as a trustee. Flexible. What else is flexible? Beneficiaries are flexible. So if I originally draw up the trust for my children and then I have grandchildren, I can add them. I can say my children and then I can say my grandchildren. I can take off my children and just leave it as my grandchildren. Flexible. Flexible. It's nice to have options. To be fixed is restricted, isn't it? If you're fixed, you can't move. Flexible. I put my money in my trust. I've got to survive for 7 years for it to be tax-free from an inheritance tax point of view. I'm going to invest that money in the trust. It's going to grow over a period of time. All the growth that I get on the trust, tax-free, straight away. No 7 years to wait. So I could put a sum of money into a trust, 50 grand into a trust, and I'll tell you what, I've got a good chance of doubling that over 5-7 years. So I'm building up the tax-free monies that my family will receive. I'm giving it away, not to anyone directly. I'm giving it to the trust, but I'm keeping control.
So you may have answered this already, but just to clarify, someone could create a trust, it could have capital in it, and then he could leave the capital for his family, but he could take the interest or whatever he raises, he could take that out and spend it while the trust is in place.
Okay. Yes, there's something called a discounted gift trust. Discounted gift trust. So I've got to tell you about this now because I've got to explain how you take income from it. So I put, for the easy sake of maths, £100,000 into a trust. I can take 5% of the initial capital out every year as an income. I've got to decide how much I want to take when I take the trust out. So initially I need to say, I want to take 4%. I want to take 3%. I want to take 5%. 5 is my maximum. Okay. That 5%, let's say we're taking 5%, 5 grand a year out of it. That is deemed by Her Majesty's Revenue and Customs to be a return of my capital. It's not the growth, it's the return of my capital. So I'm putting 100 in, and I, from the outset, say I want to take 5% back every year. Right, that is deemed. Sorry, Harry, go on.
Why is there a limit? Is it the law? Up to 5% you can take out from a trust?
Yes, the law. It's
okay.
I can, because that 5% is returned to me tax-free, income tax-free.
Okay.
So they put a limit on it. Okay. I'm telling you about a discounted gift trust. What does this word discount mean? I'm going to tell you. I put 100 grand in, haven't I? I'm going to take 5% a year. So that's 5 grand a year. A discounted gift trust is underwritten. That means there's a medical report obtained from the person's doctor. And that medical report gives the trust provider, the company providing the trust, information which enables them to establish how long I will live. How long I'll be taking income. That means, now let's say I put 100 grand in and I'm taking £5,000 out. That £5,000 is coming back into my estate. That means it's becoming taxable again. Okay. And let's say they've got my doctor's report and they're saying Mr. Oliver is going to live 7 years. Let's just say. So I'm going to be taking £5,000 for 7 years, which is £35,000. It's going to be returned to me. I then will receive a discount. And it's a word to use which is a bit confusing, but what it means is that of the 100,000 that I put into the trust, £35,000 of it will be deemed to be tax-free straight away. No 7 years. So here we go, 100,000 in a trust. They write to my doctor, I'm going to live 7 years. I'm going to be taking 5 grand out of it every year. I put 100 in, they will say, okay, Mr. Oliver, 35 grand of it is tax-free if you die tomorrow. Do you understand that? It's often difficult to understand that the first time you hear it.
No, I don't.
Well,
I do,
well,
but I
why-
don't.
why-
Like, I wouldn't know it well enough to explain it to someone else.
No,
You know?
no.
Can you do another example, please?
Yeah.
But why is that different from it being tax free? Why suddenly you need a note from the doctor? Before we said 5,000 a year is for it not to be part of your estate, you mean?
Yeah. So a certain amount of my 100,000, I don't have to live for 7 years for it to be treated as tax-free. I'm going to draw. Can you see that?
Sort of, yeah.
Can you see that line?
Yeah.
Yeah?
Yeah.
Mhm.
Oh, you can. Yeah. Okay. It's good to visualize things, isn't it? Helps to understand. Can you see that? In, out. Yes? Inside my estate, outside my estate. Inside my estate, my house, and my money. My house and my money inside my estate. Inheritance tax planning is about getting things over here, outside my estate. That's what I've got to try and do. I've got an idea. I'm going to do a discounted gift trust. Right. I'm going to set up a trust outside my estate. Do you know what? I'll tell you what, it'd probably be a good idea to draw this, because then you'll be able to look at it after and you think, oh yeah, that's what he was talking about. Trust outside of my estate. 100K. Okay. I can't get my 100K back. I've given it away. If you give something away, you can't get it back. However, with this discounted gift trust, I can take income. Which is coming back inside my estate. Okay? I want to take 5%. 5%. Okay. That's fine. Okay. $100,000 taking 5%. 5,000 a year. When I set one of these discounted gift trusts up, the provider of it is companies that we recommend for clients. They write to my doctor. Why? Because they want to see how long I'm going to live. Why? Because they want to see how long I'm going to be taking this income. How long I'm likely to receive this income. And Mystery Land Revenue, Her Majesty's Revenue, says, well, we like this because we like this trust. We're going to allow people to do this. It's tax, what is it? Avoidance or evasion?
Avoidance.
Avoidance. But we'll agree with it. And we particularly like it because this person, he's taking money from it back inside. When it's inside, we can tax it again. Okay? So we're going to give them a discount. But we've got to find out fairly accurately if anyone can tell this, they're God, but how long will I live? Okay.
Does that mean he needs a letter from his doctor every 7 years?
No, just one medical report initially.
Okay.
They're very, very clever people in this world who are called actuaries, and they assess risk, and they spend all their time working out when people are going to die. And if they've got access to their medical records, I tell you, they can have a good shot.
Mm-hmm.
Based on your genetic history. That's important. Based on your lifestyle, based on your height, your weight, where you live, all the factors. They can make a pretty good guess. So we're talking about me putting 100K in here, taking my income, $5,000 a year, and the doctor's written back and they've looked at it and they've said, Andy's gonna live 7 years. Okay?
Mm-hmm.
Andy's gonna be having $5,000 a year for 7 years. So we'll give him a little present. The present is here's the present. See that line? See the 100K?
Mm-hmm.
£35,000 of it, they're going to say to me, that's outside of your estate straight away. I say,
And
yeah.
is the 7 years significant? Could it be 10 years? If they say that you're going to live for 10 years?
They could do, yeah.
Would that increase the 35K amount?
Yeah.
It would, okay.
Yeah. So the longer I'm deemed to be going to live, the bigger the discount.
Okay.
because I'm going to be getting income for longer.
So they could make a trust at a relatively young age.
Yeah, yeah.
And have the income, and there might not be any estate at the end of it.
There might not be
any estate for the purposes of inheritance tax by the time they die.
Well, possibly, yeah.
Okay.
But it's really unusual for people to give away money when they're really young. It's usually something you do when you're retired and you're feeling quite confident that you won't need everything that you've got. You know, I'm 57. Would I give away money? Maybe a little bit, but I wouldn't give away much probably, because I've still got a long time to live. I don't know what's going to happen.
Mm-hmm.
Okay, so this bit here, 35,000, is my discount and is tax-free straight away. The rest, 65,000, I've got to live for 7 years for that to be out of my estate. It's fantastic, isn't it? The discounted gift trust is probably one of the most popular ways of mitigating inheritance tax for someone who can afford to give away money. All right. Good. All right. Did you draw it? Does everyone sort of understand that, having heard that for the first time?
Sort of, yeah.
Okay. So to draw it is a really useful thing. When I used to see clients, I always used to draw it because I used to explain the discounted gift trust to them, and they used to look at me with a blank face. Don't know what are you talking about, mate. What are you on about? But to bring it to life, it is good to draw it. It helps understanding. But when you hear these...
Painting a picture.
Painting a picture, here we go. We've always got to paint these pictures. We must be interested, Harry. Interested in people, Harry.
Mm-hmm.
We must show lots of empathy, Harry. Understanding. I'm having fun with Harry. Right, okay. So what was our first option to do with inheritance tax? Number one, my choice is to?
Nothing.
Nothing. Number two?
Spend it.
Spend it. Number three?
Give it away.
Give it away. Give it away. Give it away, but not directly to someone. Give it away with protection of the capital, with control, with the ability to change things if necessary. Once I've given something to somebody, that's gone. I can't change anything. That's why a trust is such a wonderful thing. It will help you give away money but maintain control, with the facility to draw an income with that type of trust. So that's probably the most popular ways to mitigate. However, the next, number four, the next way that I can mitigate inheritance tax is to rearrange my assets. Now, the facts are a lot of people are very nervous to give away money. It worries them because they think to themselves, God, I might need it back. I don't know what's going to happen. I might need it. I might need it for an operation that I want to get done quickly. That cost me 50k, possibly. I might need it for myself. I might have to go into care. I might need to spend it on that. All right, so it's a big thing to give away money, isn't it? It's a big thing. All right, but they want to do something about inheritance tax. Inheritance tax, if you want to do something about it, it needs a commitment from you. And this is the next, I'm going to draw it. This is what they call a loan trust. A loan trust. Loan trust. So I've done my in, out, my line. My line means the tax wall. I know that if I'm going to do something about inheritance tax, I need to get things outside my estate. But I don't want to give up any of my money. I just don't want to do it. I'm not confident. Okay, don't worry. Let me show you. I set up a trust inside my estate. Inside my estate. It's still mine. I can take money anytime I like. I can take it out. It's inside. Trouble is, if it's inside, it's still taxable if I die. But I can't have my cake and eat it. Can't have everything. I want to keep hold of my money. It's inside. It's taxable. But I like it because I can take it back. Okay. But I'm willing to make one commitment. What's that? Show you. This 100k is going to grow over a period of time. The growth goes over the tax wall into another trust. Outside my estate. Beautiful, isn't it? I've still got my money, haven't I? Yeah. Still got your 100,000. Oh, and what are you saying then? So, what's a decent return? I said, we don't know. The world is very uncertain. But I think at Thornton and Baines, there are going to be good years and bad years like everywhere. But we'd be disappointed over a decent period of time not to deliver 5 to 7% per annum. I think that's fair. Hopefully it's more, but I think that's fair. Okay, so what do you mean then? Well, what I mean is, $5K, see that, 5K is going to be going in there every year, on average, 5K. So over a period of time, I'm getting some money that won't be taxed on my death. But I've still got my capital. Wonderful, eh?
Why does it need to be in a trust if it's in our estate?
I've only loaned, so a loan trust, I've loaned the money to a trust inside my estate.
Wouldn't it accomplish the exact same goal to have capital in like a portfolio and then slowly transfer the growth into a separate trust that's a real trust? I mean, that's a trust and it will be outside of our estate, and don't have a trust inside our estate to begin with. That's my question.
Yeah, so saying something like I could put 100K in the bank.
Yeah.
And if that grew by 5% every year, I could just take the 5% out and put it in a trust.
Yes.
Yeah.
Would
yeah.
that be the same?
I mean, that's something you can do. You got some rules to think of. Got some things to think of here. First of all, what I'm allowed to give away every year. 3,000.
Okay.
Okay. Secondly, number 2, gifts from income. Do you know the gifts from income? So I'm getting £3,000 coming in. That's my pension. Lovely, lovely. I'm only spending 1,500, so I can give the difference away. So I've got to be careful that I'm abiding by HMRC rules there. With this, it's a package. I don't know how much it's going to grow by. Some years, maybe nothing. Some years, maybe 10%.
Got you. So we don't care about the rules because it's already a trust.
Yeah. So
okay.
it creates other options.
Mm-hmm.
What do you think of that? It's fabulous, isn't it?
A wonderful thing.
It is a wonderful thing. You know, it allows someone to keep access to their money, but do something about inheritance tax. It's a slow burner. This one, quicker. But my commitment is bigger here. I've given up my money. All right, I can get income, but I've given up my access to my 100,000. This one, I still have my 100,000. All I'm giving up access to is the growth.
So is the 7 years still applicable with the loan trust?
No.
Okay.
This money is immediately outside, gone, immediately, no 7 years. Okay. So we've done inheritance tax. We've done wealth management, and that was all about risk and things like that. Asset allocation. A lot of the work that we do at Thornton and Baines involves reviewing existing investments that people have. Do you know what? I can't put a figure on it, on how many people I've spoken to over the years and said, have you got any existing investments? And they've said yes. I've said, can you tell me a little bit about that? And they say, no, not really, no. I took it out 10 years ago, 12 years ago, I don't know. I just see the statement arrive every 6 months or every year. It seems to be doing okay. I say, but what risk are you taking? I haven't got a clue. What fees are you paying? I haven't got a clue.
My parents did the same thing exactly. They invested $3,000 back in 2002. They bought some Microsoft shares, and 20 years later, when I looked into their things, I finally got into their accounts to check it. Basically, it was worth nothing because they weren't paying attention to their accounts, and you know there were different taxes that were coming in, and the $3,000 actually reached zero, just because they weren't informed about the portfolio.
There we are. So look, people just like Harry's mum and dad, they invest money, they think it's a good thing, they do it years ago, forget about it. Forget about it. And it's surprising sometimes what sums of money people do forget about. It really is. And when you start asking them questions about it, they haven't got a clue. So what risk, what fees, what options have you got on there? Are there any penalties? I haven't got a clue. Don't know. So that's what we do. One of the main services is that we review on behalf of these people what they've got at the moment. And they might have taken this out 10 years ago. And I'm telling you something, when you're 50, you're much happier to take more risk than when you're 60. So they're often taking more risk than they're comfortable with for a starter. Old plans that were taken out years ago have heavier fees involved with them as well. Fees were hidden back years ago. When people invested, they didn't know how much they were being charged because the advisor didn't have to tell them. Now you have to be very transparent and you have to explain, look, this is what the charges are. So that makes up a lot of the business that we do, reviewing, helping clients get things right, rearranging their assets, sometimes into something like the loan trust. That is rearranging assets more tax efficiently. It's good, eh? Also, finally, number 5, the next way to mitigate and the last way to mitigate inheritance tax is you say to me, well, how much you got, Andy? Well, my house is worth, it's not, by the way, my house is worth 500,000 and I've got 100,000 in cash. Ah, lovely. Okay. So that's 600,000. That's right. Yeah. Tell me a bit about you, Andy. I'm a single man. I've got no kids. Okay. Have you made a will? Yeah, I've made a will. It's all to my my mate who I play darts with down the pub on a Wednesday night. He's going to have it all. Oh, that's nice for him. Okay. So what's my inheritance tax liability? I've got to work it out as well.
Is it 110?
Who said that? Virgil. Well done. 110. Okay. Thanks very much. So you mean that I'm going to pay £110,000 in tax on my estate? Well, you're not, Andy, but that's what someone will have to pay. Yes. You mean my mate down the pub's going to get 110 grand less? Bloody hell. Can do a lot with that. You can do a lot with £110,000. You can buy 3 houses in Wales. Did you know that? 3 houses in Wales for £110,000. Okay, so what can I do about it? Number 1, nothing. Number 2, spend it. Number 3, give it away. Number 4, rearrange it. Number 5, insure the liability. Insure the liability. So I take your inheritance tax bill, 110. Yeah. Okay. What I'm going to do for you, Andy, is I'm going to apply for a life assurance policy. What's that? We're going to insure you. We're going to insure you for a death benefit of £110,000. Oh, okay. And we're going to see if we can get this, because it's got to obviously go through a medical report. But you're fairly healthy, so you should get it, okay? Yeah. And what do I have to do? You have to pay for it. You have to pay for it every month. Yeah, I don't mind that. I've got enough income. You can also pay for it every year. You don't have to be monthly. You can pay it yearly. Yeah, I'll do that then. Okay. And what we're going to do with this life insurance policy, once they've accepted you, is we're going to put it into a trust, so that life insurance policy pays tax-free. A life insurance policy in a trust pays tax-free on death. Inheritance tax-free on death. Oh, that's really interesting. So who am I going to put it in trust for? Well, it's your mate, isn't it? Down the pub, playing darts. It's him. Because you're leaving everything to him, and then he's going to get this £110,000, which is going to pay him tax-free, and he can use that money to pay the tax. Number 5. A lot of people do that.
Could you repeat the you said a life insurance policy pays
tax-free when it's in a trust.
Okay, thank you.
Did everyone hear me? Everyone got it? Good. All right. That we're going to do another. What time is it? We're going to do another, I'd say, 20 minutes, and that'll be it. And for Kimberly, Sam, Oliver, and Virgil, you'll have heard this before. I've got to do equity release with these guys. Okay? So I'm going to do it quickly, but it'd be good for you as well, because I'm going to go through this equity release. Now, my four new people I don't think they like this very much. But equity release is probably the biggest growth financial services product at the moment. And I think it will be for the next 15 years. A bit of background for you is that over the last 30 to 40 years, property prices in the United Kingdom have consistently gone up. There has been dips, yes there has, and they're severe dips, but over that period of time, properties have gone up a lot. In the UK, it's very important for us to own a house. It's very aspirational. It's difficult now, isn't it? But it's very aspirational. People want to own their own homes, quite rightly. And because of the economy as well, which has generally been very sound and very strong, it's attracted lots of foreign investment as well. So that has again boosted property prices in the UK. But where we're left with now is a situation where a lot of people are property rich but cash poor. So they're sitting on these homes which are worth a lot of money, but they actually haven't got very much in savings, and their incomes aren't very good. So they're struggling. They're going to Aldi instead of Waitrose. It's a big difference, isn't it? They're perhaps not having holidays. So they're really struggling to survive comfortably. But they're sitting on this house and it's worth a lot of money. So equity release has become more popular for that reason, but there are other reasons as well. Back prior to 2008, lots of people could borrow money at a drop of a hat. Banks were giving away money. You know, you could even walk into the bank and they'd say, "Good afternoon, Andy. What do you want?" "I want a mortgage." "Okay, no problem. How much do you earn, Andy?" 100,000 a year. "Do you? That's good. Okay. Can you prove it?" "No. No. But don't worry about that. Don't worry about that. That's fine. Just make us a declaration. Just declare, self-certify that you're earning that money." "Oh, I'll do that, certainly, certainly." There we are. "Oh, lovely. Now I've got my mortgage and off I go. I've got this house." That was all fine. It worked for a while until property prices started to come down in value. And the banks, you know what they did? They were really, really irresponsible, and they lent this money, and then what did they do? They sold the debt. And it ended up nobody knew where it was. So it all got in a bush, and that was the result. But people at that time were borrowing money, and they were borrowing money interest only paying the interest. So all those times in the in the 90s and the early 2000s, these mortgages are starting to come to an end in the next few years. And people are faced with the fact that they still owe all this money that they borrowed in the first place. What to do? I haven't got 200 grand to pay this mortgage off. What am I going to do? Sell your house to pay it. So that's coming more to the fore, and making equity release more common is that it provides the ability to pay off interest-only debt. But there's lots of other reasons why people do it. They do it to help their children, get on the housing ladder. They also do it so that they can maintain their property in a good shape. They can put on a new roof. They don't have the water leaking in. They can have nice new windows. They can build a place for themselves out the back garden or something where they can have a bathroom and a toilet. Because they think to themselves, hold on a minute, I'm going to get old one day, and what's going to happen to me is I'm going to have someone to look after me. Because I don't want to go in a home. That's the last thing I want, go in a home. So I want to be able to be looked after in my own house. The biggest thing that predicts that is being able to wash, go to the toilet and sleep downstairs on one level so someone can look after you and you can get around. Now, you might say, why don't you sell your house and downsize? Get yourself a smaller little place. Get yourself a nice ground floor flat. Get yourself a nice little maisonette. Because people find that some people find that difficult to do. The longer you leave moving in life, the harder it gets. It's a big thing. It's a big thing as you get older to move. And people say to you, this is true, what am I going to do with all my books? Where am I going to put my stamp collection? I won't be able to fit it in a little flat. And that's the most important thing to them, their books or this stamp collection or whatever. My collection of porcelain dolls. Where am I going to put them? So that's a factor. Also as a factor is that people get very, very attached to their communities. And they have friends in and around where they live. And they go to church where they live. And they go to the social club where they live. And they have their doctors near where they live. And they trust their doctor. And they don't want to go to a new doctor. And they have the supermarket across the road. And they could get on the bus. Lots of factors that make people want to keep their home, their family home. Also, they can be emotionally attached to their home. It might be where their children grew up. They might want to keep it, stay there. It's full of memories. But I say all that stuff. One of the most important things to confirm before you speak to somebody about equity release is why have you thought about downsizing? Have you thought about selling and buying a smaller place and having some money that way? That's an important factor. Okay, equity release. There are two types of plan available. Lifetime mortgage. And the other is, what's the other one? Home reversion. I thought one of you lads might have piped up there. Home reversion scheme. So a lifetime mortgage and a home reversion scheme. Lifetime mortgage probably makes up 99% of the cases written in the United Kingdom. The reason for that is a lifetime mortgage is a loan. It's a mortgage on your property. A home reversion scheme is a sale of your property. So with a home reversion scheme, let's say your property's worth 400,000, you'd find a company that would give you 200 grand for that. 200 grand, and that's real figures. They'll give you about 50% of the value. 200 grand, yeah, have it. But they then own the property. And when you die, they sell it. You have the right to live there. So I suppose they're taking a little bit of a gamble because property could go down. I wonder what will happen to property after all this. What do you think? Anyone got an opinion? Don't know. I don't think it's going to go up much. Do you? There's a lot of people who are going to be. Well, am I being a bit gloomy? I don't know. A lot of people. Unemployment's going to be higher, isn't it?
Possibly.
Yeah.
We don't really know yet, do we? Because this is.
No, we don't know. In fact, I haven't thought about that, to be honest. But I know less people are going to be in work, probably.
We know tax is going to go up. That's without a doubt.
Tax going to go up, which puts
Somehow.
Yeah, which puts people's what people have in their pockets down.
Mm-hmm.
It's a great time to borrow. I mean, there's never been lower interest rates. It's a great time for borrowers. It's cheap. I don't know.
Couldn't the central bank, print more money, much like the US does,
Yeah.
and just borrow from itself and just dilute the currency?
Yeah. I mean, over the last week or so, we're seeing markets going up in value. There's only one reason for that. There's only one reason.
They restarted they've made plans for when everything's going to go back, I think.
Yeah. And they've chucked a load of money. They've printed a load more money. Anyway, we're going off the subject because I said, what's going to happen to house prices? Well, I don't know. So the home reversion scheme, because it involves selling your property and you get such a low percentage of its real value, it's not very popular. What is extremely popular is a lifetime mortgage. So that involves a loan, a mortgage. So let's take the 400 grand house again. Probably the maximum mortgage you would get on that maximum loan would be about 120k. Okay, you'd be given 120k. You'd have to specify very clearly what you need that 120k for. What's it for? And whatever it is, that's an example. 120k is a lot of money. Maybe you could withdraw less than that initially and then use top-ups as you needed it. I wanted to give you an idea of what the maximum lifetime mortgage rate would be. So it's about 30% of the property value. But you're not selling that property, you're just borrowing against it. Okay. In regard to the interest, you've got two choices how to deal with that. You can ask for the interest to be rolled up on top of the loan. So you never pay any interest back. Never pay it back. Never pay it back. It just rolls up. The loan gets bigger and bigger and bigger. In current rates of interest, the amount that you borrow on a lifetime mortgage will double after 18 years. So let's say I've got my house, 400k, I've got 120 I've taken out of it. In 18 years' time, that loan will then be 240. Bear in mind the property is likely to go up in value. There's no guarantee, but it's likely to go up in value if we can use the past as any indication. Okay, so my interest rate, I can roll up, roll on top, or I can pay the interest. So the loan remains the same.
Can I ask something real quick before you continue about home reversion?
Yeah.
Thank you. Let's say that you take out a home reversion scheme and you get paid half price of whatever the home is valued. Could you then, before you die, pay back something? Like does it work like a mortgage? Like, could you pay it back and then they don't get it when you die?
Oh, I don't think so. I think,
okay.
I mean, I've long years and years since this is what got equity release a bad name, because it is a bit of a dirty name, equity release. But no, I don't think so, Harry. No.
Okay, thank you.
No, you've changed the ownership of the property.
There's no going back. Okay.
There's no going back. No. Okay, so the interest, I can roll up or I can pay. The interest rate can be variable. That means it might go up and down, or it can be fixed. So, I mean, who wouldn't take a fixed rate now? Goodness sake. You know, the interest rates aren't going to go down any further. You're getting the best possible interest rates now. So, to borrow, which is bad news for savers, good news for borrowers. Okay, so fixed rate of interest, you will pay that rate of interest for the length of the loan. What's the length of the loan? Till you die, or going in a care home. The lifetime mortgage must be repaid if you go in a care home permanently, not on respite, permanently. The house must be sold to repay the debt. The minimum age you could take a lifetime mortgage is 55. You won't get anyone to do it before then. Any company, that is. The product doesn't exist before the age of 55. There's no upper age limit. How much you can borrow is down to three things. Number one, how old you are. Number two, how much the property's worth. And number three, your health. Because if you think health, what's that got to do with it? Well, if you're in poor health, you're more likely to die. So the company are more likely to get their money quicker. That's the way of life. Okay. All lifetime mortgages come with a guarantee called a negative equity guarantee, which means that the loan can never be more than the house is valued at. The loan can never climb above the value of the house. So you can't leave a debt. People will come to you and they'll say, and they will because this is a huge growth area, they'll say, how much can I borrow on my house then? And you'll find out for them. Let's stick with a 400 grand house. You'll say it's a maximum of 120 you could borrow. Okay. They might say, I'll have that. I'll have that, 120. Lovely, lovely. It's great. You say, what do you need 120 grand for? And they say, oh, well, I want to do this, that, and this, and that. Okay, let's start with the first thing. I want to have a new kitchen. Okay. How much is that going to cost? 20 grand. When are you going to do that? I'd like to do that now. Okay, that's fine. What else do you want to do? I want to go on a cruise for 6 months around the Greek islands. Okay, how lovely. How much is that going to cost? 20 grand. Okay, when are you going to do it? I'm not going to do that till next year. Why take the money now? Because you'll be paying interest. So it's often better to release in chunks when you need it. Okay? Good. You have to be careful when you release equity for a lifetime mortgage, because all of a sudden people are going to have money in their accounts, and some people are on means tested state benefit. So things like pension supplements and things, what else is means tested? Income supports and things like that. Now, if they've got a load of cash in the bank, they'll lose their means tested benefits. Okay, so you've got to have a little conversation there. But there we are. I think you understand the opportunity for lifetime mortgages. I've really enjoyed doing some lifetime mortgage business because I've seen what difference it can make to people's lives. It's wonderful. And, you know, there's a lot of older people struggling, and it can make such a big difference. However, it's got to be right for them. And you've got to talk about the other options that are available. For example, downsizing. Okay, it's got to be right for them. But it can make such a big difference. Good. All right. Okay. So Charlotte, Andrew, Christy, Harry, I think we're done. Okay, there's some of the products that I've been asked to go through with you. So we've been through equity release. We've been through inheritance tax. We've been through the marvellous discounted gift trust and the fantastic loan trust. And we've been through things like risk, the importance of assessment of risk, and diversification within portfolios and the different asset classes. Okay. So I will send you tests. Okay. But I'll probably do that later this evening or in the morning. And if you could complete those and send them back to me, I'd appreciate it. And of course, being honest, I know you won't cheat. Otherwise, you'll have to live with that for the rest of your life. Okay, good. So you can go do your stuff. We'll stay on, the other lads.
Okay.
Thank you, Andy.
Thank you.
Good.
Bye.
Good.
Thanks,
It's nice to
Andrew.
see you. Nice
Yeah,
to
you
see you.
too. Bye.
Bye-bye. Hey, that's us. Okay, let's take a break, shall we? You've got a test there on equity release. If you could complete that now, I'm going to allow you, I think 20 minutes is adequate. It's not a long test. 20 minutes starting from now. we spoke about let's get a discretionary trust, which is also called a flexible trust. To further confuse you, that's also called a chargeable lifetime transfer. Chargeable lifetime transfer, or CLT. So you're going to have to, there's a question there asking you about a CLT, and that's the features of a flexible trust. So all those things we spoke about that we can do with a flexible trust. A PET, a PET, that's a fixed trust, or also known as a bare trust. So when you see PET, potentially exempt transfer, that's what it stands for, potentially exempt transfer. All right, bear with me, I'm just going to have a look at the test. The features of a DGT, we covered those. Remember that drawing that I did for you? The loan trust. This £3,000 that you can give away every year, that's something which you can use to pay into a life insurance policy. WOL is whole of life policy. So it's the annual exemption. And you should also give some thought to including that gift in people's wills. So making sure that you use your exemption. But see how you get on with that IHT test that you've got there in front of you. I'm going to give you 20 minutes Lovely, thank you. You'll see that you have another test there. I'm going to talk through a bit more about this though. If you could bring the test up in front of you, we can see that the first question is, what are the two types available? So I didn't cover this one with you. So you get two types of trusts that are available. Sorry, two types of discounted gift trusts. Talking about fixed and the discretionary here, there's two types available. One's called an insured scheme, and the other one's called a capital redemption scheme. So insured and capital redemption. Now the difference between the two is that the insured one comes to an end on the death of the settler. The capital redemption one can last 125 years. The settler can't be the beneficiary as well. It's totally pointless, isn't it? I'd like you to start now, and thank you.